Hi, I'm Douglas Jonas. I'm live on the floor of the New York Stock Exchange, joined today by Steve Cook. He is the head of ETFs at Harbor Capital Advisors. As a reminder, the NYSE does not recommend investments or investment strategies. Steve, thanks for joining us.
Doug, thanks for having me. It's great to be here.
You have a couple of new ETFs, but I want to talk about active in an ETF and how you guys think about a transparent versus a semi-transparent wrapper.
Yeah, it's great. So again, I think what's happening in the ETF space now is super important. I think a lot of the innovation that has come with the new ETF rule is allowing traditional active management shops to bring ETFs, to bring creative ETFs to the market that you really couldn't do before. And I think one of the debates that those folks have when looking at getting into the active space is, do we bring a product that's a semi-transparent or do we go fully transparent? And I think there are overarching advantages to providing investors with full active transparency in the market. So where we can, Harbor is looking to provide investors with active, transparent products because it gives them an advantage when they're evaluating an ETF to know and understand fully what they own and what's in the product.
So talk to us about ETF liquidity. This comes up all the time. People are thinking, hey, what are the best practices for trading? What drives ETF liquidity? What could you share with us?
Certainly, and especially when you're looking at new products that are just trying to kind of get their momentum going. Oftentimes those products don't have the same level of daily trading volume, and so folks tend to think that it's more difficult to trade them. And really it's not. ETF liquidity is driven by the underlying securities within the product. And so if you evaluate a fund, if you're looking again at the transparency of an ETF and you're saying those underlying securities are super liquid, they trade a lot, then it's very easy for a market maker or the exchange to be able to help provide liquidity in that ETF. And so just because a fund doesn't have a lot of average daily volume in the beginning doesn't mean you have to shy away from it. You can go into the market and buy that ETF and know that you'll get great execution on those products.
Now, you mentioned the idea of evaluating an ETF. What are some best practices? Someone's looking at a new ETF. How do they evaluate one?
Sure. So again, you have the holdings, you understand how the underlying securities in that ETF trade, and you know that you're confident that you can go ahead and get execution and liquidity in that product. And then the next step is really, how do you then go about processing those orders? And so when you're looking at a newer ETF that has slightly less volume than, say, one of the larger ones like QQQ or Spiders, or the thing that you want to concentrate on is utilizing limit orders, utilizing those limit orders during times when the exchange has more liquidity. So maybe avoiding the first 15 minutes at the open, maybe not doing your trades at the 15 minutes of the close, but putting in a limit order throughout the day when there's really good volume in the underlying securities and the price for those underlying securities is well known to the market.
Great tips, great best practices. Thank you very much, Steve. That's Steve Cook from Harbor Capital Advisors. Now, if you caught this episode live and you're looking for more ETF educational content, go to our website, homeofetfs.com. That's homeofetfs.com. We're live on the floor of the New York Stock Exchange, the home of ETFs.